Many technology startup companies do not have substantial revenues, and they're merely containers for the product designs, patents, and other technology assets. The value of the company here could be calculated as the value of the technology assets it contains. Before acquiring an asset, like a new technology, a buyer will usually make a build versus buy calculation and estimate how much it would cost to build the asset using its own team and its own resources. The buyer may argue that the value of the asset is capped by the cost the buyer would incur if it reverse engineered and built the asset in-house. Using the build cost valuation method, the company is considered to be worth no more than what it would cost the buyer to rebuild the product or the asset by hiring an in-house design and development team. As an example, if the buyer were acquiring a high-tech product design that would take 5 engineers and a project manager 24 months, 2 years to reverse engineer, the buyer may estimate that the in-house build cost was perhaps $2 million. However, a good negotiator representing the seller will point out that when this internal development cycle project cycle is complete in 2 years' time, the market will have changed considerably, and the opportunity will have expired. In this situation, it's not unusual to apply a time-to-market multiple to recognize the momentum generated to date and come up with a more reasonable valuation from the perspective of the seller. If the buyer's build cost is estimated at $2 million, the seller may argue that the time-to-market multiple may be 3x, so the value would be set at $6 million, 3 times $2 million. The ability of the seller to negotiate the time-to-market multiple may be driven by the bargaining power of the buyer versus the seller. As usual, the seller would be in a stronger position if it had engaged with several competing buyers. If the inventions making up the technology assets are patent protected, the buyer would be infringing the patents by reverse engineering. So the build cost valuation can be invalidated as a result of patent protection. The buyer is excluded by law from building the technology in-house, and the seller can argue that the build cost is not relevant to valuation.